Would you like to know the number one method I'm using to achieve returns like this without spending a lot of time on research? Well, then this is the video you've been looking for. In it, I'm going to share the basics of Elliott Wave Theory with you, or at least make sure that you understand what it is by the time you're done watching this video, and what allows me to outperform the markets when so many other investors are looking at 10, 20, 30 and more % in losses so far during 2022. But before we get to that, as always, let's get the usual disclaimers out of the way. Everything I share in this video is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions and make your own decisions. Besides that, if you don't want to manage your own portfolio, you can always go ahead and copy my portfolio on eToro by following the link in the description or the first pinned comment down below. But even then, it doesn't hurt to understand the basics about the number one method for technical analysis that I'm applying to manage my portfolio. With all that covered, let's take a look at Elliott Wave Theory, what it is and how it works, or at least the basics of how it works. Elliott Wave Theory was created by an American accountant named Ralph Nelson Elliott, born in 1871 in Marysville, Kansas, that lived in San Antonio, Texas until he eventually passed away in 1948. During his life in the early 1930s, Mr. Elliott began a systematic study of 75 years of stock market data, including index charts with increments ranging from yearly to half-hourly prices, and later published his conclusions in a book with the title The Wave Principle. The core takeaway of his research was that while stock market prices may appear random and unpredictable, they actually follow predictable natural laws and can be measured and forecast. He concluded that stock market prices trend and reverse in recognizable patterns that are repetitive in form but not necessarily in time or amplitude. And just like for other theories and methods out there have been people advocating for Elliott Wave Theory and those that doubt its accuracy. Among those that strongly believe in the wave principle, A.J. Frost and Robert Prechter are nowadays the probably most prominent, considering that they published their own version of the book called Elliott Wave Principle in 1978 themselves, and that Robert Prechter was quite a prominent character in the 1980s and used Elliott Wave Theory to predict first the crash and then the start of the bull market that followed, and just last year as well used Elliott Wave Theory to predict the December 2021 highs in the Dow Jones and other indices with incredible accuracy months in advance in his monthly The Elliott Wave Theorist subscription service that you can, by the way, find also by following the link in the description down below. If you're now curious about the books, I also have some good news for you. While you can order both versions online, you can actually read the updated version by A.J. Frost and Robert Prechter for free online as well. You can find links to both books and the free online version in the description and the first pinned comment down below. However, let's get back to the topic at hand. Obviously, for many of us, me included, the Black Monday of 1987 that made Robert Prechter in quotes famous is something we don't remember, simply because, at least in my case, I wasn't even 1 year old at the time. And considering the overall bull market we had since then, it's hard to believe that Elliott Wave Theory, or any other indicator or tool for that matter, can actually predict future price movements. The big question therefore is, how accurate is Elliott Wave Theory and how does it work? To answer this question, we have to understand at least the basic concepts of Elliott Wave Theory. As mentioned, Ralph Nelson Elliott concluded that stock market prices trend and reverse in recognizable patterns, and he isolated 5 such patterns, so-called waves, that recur in market price data. The first important lesson about Elliott Wave Principle to learn here is that out of those 5 waves, 3 are always in the direction of the trend and are so-called motive waves, whereas 2 are counter-trend movements and are called corrective waves as shown in this illustration. Motive waves are usually labeled 1, 2, 3, 4, 5, whereas corrective waves are in most cases labeled A, B, C, with a few exceptions that are beyond the scope of this video, but that are also covered in the books and the one-page Elliott Wave Theory cheat sheet that you can find linked in the description down below. Mr. Elliott defined those patterns and variations of them and also described how they link together to create the same patterns again on a bigger scale and vice versa. Simply put, specific combinations of these waves make up waves of so-called higher degree, as you can see here, where we can see wave 1 and 2 of 1 degree and how these waves themselves again consist of waves following the same rules. And one important thing to point out here is that while the overall trend in all these illustrations used in this video is upward, the same patterns also apply in bear markets or general declines. In that case, the illustrations would simply be inversed. However, none of that explains why or how Elliott Wave Theory is able to predict anything, considering that simply drawing such wave patterns on the chart doesn't get us anywhere. Why are markets following waves in the first place? And to answer that, let's take a look at an illustration that you probably already saw in one or more variations shared across social media and on several trading platforms. As we know, people tend to become greedy when markets move upwards and eventually lose all hope when they are going down, which among other things is probably the #1 reason why the stockbroking industry has the unsaid 90-90-90 rule, stating that 90% of traders lose 90% of their capital within their first 90 days of account opening. And believe me, I was no exception to that rule when I first dabbled with forex trading and other forms of investing years ago and busted my fair share of trading accounts before I learned about Elliott Wave Theory myself. Getting back to the topic, if we look at this illustration here showing the idealized Elliott wave progression, we can see that it's nothing else but a better explained or structured version of the bull market part we saw in the previous illustration. Which brings us to the conclusion that Elliott Wave Theory is simply a set of rules that allows one to predict market movements with sometimes unbelievable accuracy based on human nature or mass psychology. And this is very important to understand because it also teaches us that Elliott Wave Theory is most reliably in assets that are traded by a huge number of people. In other words, Elliott Wave Theory will perform better with indices like the Standard & Poor's 500 or the Dow Jones Industrial Average than if it's used for individual stocks or commodities. That, however, doesn't mean that you can't use Elliott Wave Theory to label and predict movements in individual stocks or other assets at all, but simply that there are cases where it's not going to be easy to apply it in the first place. To summarize what we learned so far, Elliott Wave Theory works best in indices and has its limitation when it comes to individual stocks or other assets. The core premise is that there are recognizable patterns that always consists of 5 waves, out of which 3 are so-called motive wave and 2 are so-called corrective waves, which themselves again can be broken down into other motive and corrective waves of different degree. The last thing that you need to know is that each of these 5 ways has to follow specific rules that are obviously explained in the books and that one cannot just randomly come up with the labels for wave 1 to 5. For the purpose of this video, I just want to share 2 of the, in my opinion, most important rules with you as well. First, in a motive wave, so a 1, 2, 3, 4, 5 wave moving in the direction of the trend, the third wave can never be the shortest wave and wave 4 can never enter the territory of wave 1. Unless the 1, 2, 3, 4, 5 motive wave is something called a leading or ending diagonal and not an impulse wave, which is a relatively rare occasion. Leading and ending diagonals, for that matter, are variations of motive waves that, as you probably already figured out, follow slightly different rules. Obviously, the books that you can find by following the links in the description down below explain all of that in greater detail with an abundance of examples, but you can also use the link down below to download the Elliott Wave cheat sheet that contains all forms and their rules on one single page. Although I have to warn you that if you're new to Elliott Wave Theory, that one page alone might be a bit overwhelming, but in combination with the Elliott Wave Principle book by A.J. Frost and Robert Prechter, that as mentioned you can also read for free online, it becomes one of the best tools at your disposal. The last thing I want to show you in this video is how you would start to apply Elliott Wave Theory to your charts on, for example, a free service like TradingView, which you can also find linked in the description down below. If you are looking for a premium alternative to TradingView that works well with Elliott Wave Theory, I would recommend that you take a look at Motive Wave, which is also linked down below. But to make sure everyone can apply what I show here in this video, I'm going to stick with TradingView for now. And I know I said that Elliott Wave works best in indices, but for this example, let's use a fairly popular stock, Tesla to be more specific, because it will also allow us to discover some of the challenges you might face with Elliott Wave Theory from time to time. To get started, the first thing we'll have to do, since each impulse wave consists of more waves of a smaller degree, we always have to start by looking at the biggest time frame possible that still allows us to identify wave patterns. In this case, this would be the monthly time frame showing Tesla's price development since June 2010. Next, we have to decide if we should use an arithmetic chart like this or stick with the logarithmic chart we have here. When we're looking at huge percentage movements, and I mean really huge, like in this case where the low in July 2010 was around $3 and the all-time high we can see is at around $1,240, the log scale makes more sense. However, if you're in doubt, you can always try both and see on which one the wave patterns are easier to identify and then simply work with that one. To simplify things further, I'm going to apply something called the Kennedy channeling technique created by Jeffrey Kennedy, one of the many instructors working for Elliott Wave International. And on a side note, Jeffrey Kennedy also published a 38-minute course just teaching the technique I'm going to show you now real quick, and you can also find a link to that course in the video description down below. The last thing I want to mention here is because it's really challenging to label the charts and at the same time document what I'm doing, I already did that part in advance and took screenshots of crucial steps along the way. And also to deal with the #1 argument of Elliott Wave Theory skeptics that insist that it's not useful because it's applied to existing past data, I'm going to use TradingView's rewind feature, so to label the chart as it develops from Tesla's IPO in 2010. To get started here, we would need to identify a low point followed by a high point and another correction that does not create another new low, and the first occurrence of that would be in December 2010. Now we simply add a new trend channel to the chart, as you can see here, that connects our starting point with our low, that would be our end of wave 2, and align the parallel line so it goes through the high point, which would be the end of our wave 1. Next, we would look for a breakout to the top from the channel, as according to the Kennedy channeling technique, that would identify or indicate a third wave movement, while any new downwards movement would indicate that our second wave isn't yet finished and requires us to adjust the channel accordingly. It's important to point out here that we do not have to pick the lowest low, but adjust our channel to the latest low instead. We repeat that process until we either have a new low that goes below our existing starting point to pick as a fresh starting point, or a breakout to the top that would indicate that we are now in our third wave movement. And again, as a reminder, any new high that doesn't break out from our channel also requires us to adjust our channel accordingly. We keep doing that until we are eventually rewarded with our breakout from the trend channel, which by the way is now our so-called base channel. Here, with the candle closing outside of our base channel at the end of April 2013, we would have two options. First, we could buy Tesla straight away or play it safe and only create a pending buy order that would use the May 2013 value of our trend channel for the market entry if the price again falls back to retest that channel. In both cases, we would have used a stop loss at our wave 1 high at back then $7.99. Also, if we would want to confirm that these are indeed our first two waves, we would have to look at a smaller time frame and be able to fit an entire 5-wave motive wave pattern into our wave 1 and at least a 3-wave ABC corrective pattern or a variation of the possible corrective wave patterns into our wave 2. Since we are, however, going to do something like that later on, I'm going to skip this here for now. Moving forward, we are now supposedly in our third wave, and to find its end and with that the time for our exit, we go ahead and add another trend channel that connects our point 1 with whatever high we can find after the third wave move started and draw a parallel through our point 2 like this. Any breakout to the bottom of this channel would indicate that we are now in wave 4, while any new high would either indicate that we haven't yet reached the end of wave 3 and that we have to adjust our trend channel like I'm going to do here. The channel we created now, by the way, is the so-called acceleration channel, and as mentioned earlier, a breakout to the bottom would indicate that we are now in the fourth wave. And just to mention it, there are also ways to estimate the potential price target for the end of our wave 3 that are explained in the book by AJ Frost and Robert Prechter, and I'll likely cover those in separate videos in the future as well. Since we are using Kennedy's channeling technique here, however, we just keep adjusting our channel with every new high until we have a breakout to the bottom, with preferably one additional candle closing below the channel, like it is the case here at the end of September 2015. Our trades that we opened in May 2013 at around $10.75 per share can now be closed with the end of September 2015 candle at around $49.68 per share. And we can now move on to use Kennedy's channeling technique to try to identify the end of wave 4 to then enter another long position and profit from the fifth wave movement. And to do this, we add the so-called deceleration channel to the chart, which is actually not a full trend channel, but just a trend line. The channel, or in this case trend line, would confirm the end of wave 4 once the price breaks out to the top. In the meantime, something important to note is that according to Kennedy's channeling technique, wave 4 will often, but not always, either touch the top or the median of our base channel, and as such, even before we get to see a breakout from our fourth wave deceleration channel, we could already have two pending buy orders that we adjust each month to the price point that reflects the top and median of our base channel. The stop loss in this case would again be at our wave 1 high at back then $7.99 roughly. To properly add your deceleration trend channel, or in this case trend line, to the chart, simply create a new trend line that is extended to the right and start it at the point of your wave 3 and connect it through the next relatively high point that you can find. As mentioned, any breakout to the top of that trend line would indicate the start of the fifth wave movement. In our case, it appears that the price won't hit the base channel, but we have a breakout with another candle closing outside of our deceleration trend line already in May 2017. So we could now remove our pending orders and instead buy at the end of May at $68.20. Again, with our stop loss being at our wave 1 high at back then $7.99. With that, we can now also add our last channel, the so-called destination channel, according to Jeffrey Kennedy's channeling technique, by connecting point 2 and 4 and drawing a parallel line through point 3. I've made this channel a little thicker to make sure it's still visible among all the other lines we've already added to the chart. And according to Jeffrey Kennedy, the fifth wave will often reach either the median or the top of this channel, and as such offers us areas where we can consider taking some profits, or as an alternative where we can implement a trailing stop loss. In our case, however, the price doesn't appear to move up and eventually even falls again below our deceleration trend line and unexpectedly still ends up touching the top and then the median of our base channel, which could mean that either our third wave wasn't finished yet or that the wave 4 contains a corrective pattern called a flat, in which case the wave B of the entire ABC corrective pattern always goes beyond the start of wave A and as such causes a new high, which would indicate that our point for wave 4 is wrong and as such our destination channel also has to be adjusted accordingly. And this is one of the many reasons why I picked Tesla specifically for this video, because this reminds us to always confirm our waves by verifying that the required wave patterns of lower degree fit into them accordingly as well. With our new destination channel in place, we can now also adjust the profit targets based on the new median and top of our destination channel as well. And while we ended up entering the market early, just a few candles later we finally get to see what appears to be our fifth wave rally and how it touches our first profit target at the median of our destination channel. After that, we can see a correction before we eventually also reach the top of our destination channel, our second potential profit target. At both of these points, we could either close the position we opened at $68.20, equip them with a trailing stop loss, or even better, look at a lower time frame and apply Kennedy's channeling technique there to confirm the fifth wave itself and get a narrower destination channel instead. Without looking at a smaller time frame, that could look something like this. And it's important to note here that while according to Kennedy's channeling technique the fifth wave will reach the median or top of that channel, in some cases it can go further than that, which for Tesla is clearly the case here. The Elliott Wave Principle book provides additional information on how to predict the potential tops, but for the purpose of this video there's just one last neat trick that I want to show you. For that I simply copied our destination channel and moved it exactly on top of itself to basically just extend it. And with the new median and top we get additional profit targets for cases where wave 5 goes beyond the regular destination channel. The same trick, by the way, also works for our base channel when we're waiting for wave 4 to touch the top or median there. If our third wave move was very strong and the gap between them is fairly big, then it may happen that wave 4 doesn't touch the actual base channel. So by also copying the base channel and adding it on top of itself, we get 2 additional potential points for market entry. And as we can see, Tesla's all-time high reaches precisely the median of that extended destination channel. Now obviously we didn't know that this would happen, but if we initially opened 4 positions instead of just 1, we could have closed the first around the median of the main destination channel and adjusted the stop loss levels of the remaining 3 positions after looking at the wave patterns of lower degree within our 5th wave. Either way, following Kennedy's channeling technique based on the data we had at the time would have provided us with 2 incredible trades over the course of the last 12 years. With that, we applied Elliott Wave Theory to Tesla up until the recent all-time high and learned a quick and easy way to identify impulse wave patterns by using a few trend channels. The big question now is, how does that help us in determining where Tesla is going from now, and why did we do it in the first place? The reason why this initial work was necessary is to identify in which overall wave Tesla currently is. And we can now confidently say that right now Tesla is in wave 2 of the biggest degree, because the entire 1, 2, 3, 4, 5 impulse wave from Tesla's IPO to the last all-time high itself is nothing else but wave 1 of an impulse wave of a bigger degree, in which we have to wait for our wave 2 to form to give us our new base channel. In other words, according to our application of Elliott Wave Theory, Tesla should develop a corrective pattern like, for example, a simple ABC zigzag that could look something like this. And without looking closer to confirm this zigzag, we might now be tempted to already buy Tesla shares. But if we also consider that wave 2 often retraces into the territory of wave 4 of the previous impulse wave of 1 smaller degree, we get our first indication that this is most likely not the case, but that we are more likely looking at something like this, since according to our one-page cheat sheet, 48% of all second waves are zigzags, and that wave A in a zigzag is in 93% of cases a regular 1, 2, 3, 4, 5 impulse wave. So we can again apply Kennedy's channeling technique to try to map out how that wave A should develop, assuming that the correction we saw so far is just wave A of a bigger corrective pattern. Based on that, it would appear that we so far only seeing wave 1 and 2 of a smaller degree of the 5-wave impulse that will most likely make up wave A of the corrective pattern here. I know there are plenty of people disagreeing with me out there, but according to this, our area to buy Tesla again would be anywhere between $35.40 and $58.28. And only time, and with that additional candles on the chart, will tell if that wave count stays valid or if I made a mistake along the way. That, however, doesn't tell you right now which way Tesla is going to move, which is again one of the reasons why I picked specifically Tesla for this example. Overall, what you can learn from this is that while the principle of identifying waves sounds easy, for almost all charts that you apply Elliott Wave Theory on, you will be able to apply more than one variation of wave patterns that are following the rules as explained in the Elliott Wave Principle book. In some cases, all those variations will point towards the same direction and provide you with an easy decision. In other cases like this one, however, without confirming our 2 possible patterns on lower time frames, they do unfortunately give us opposing predictions. If we assume the current correction is already a complete zigzag, then we might have a buy signal since we would expect the eventual start of wave number 3. On the other hand, if we assume that the current movement is just the beginning of the 1, 2, 3, 4, 5 impulse wave that will make up wave A of a potential bigger ABC zigzag corrective pattern, then we would have a sell signal for now. And let's not forget, since we didn't bother to confirm any of our wave patterns on lower degrees, it's also possible that after confirming we learned that the all-time high so far wasn't the end of our fifth wave and there is actually more upside to come. That doesn't sound like Elliott Wave Theory is a lot of help or use, but thankfully in situations like this you have a couple of options to determine what you should do. First, as mentioned, beside rules, there are also guidelines that apply to wave patterns, and whichever of your labelings also fulfills the most guidelines should be considered the primary and with that the most likely labeling. That doesn't mean that this one will always guaranteed turn out to be true, but will provide you with the price ranges to enter the market, profit targets and specific stop loss levels that will make it easier to decide if a trade is worth it considering its risk-reward ratio. Your second option is, if you can't make a decision now, you could work your way down and confirm your waves by verifying that they all consist of the right waves of lower degrees. So for the assumption that this is already a complete ABC corrective pattern, confirm that wave A is a complete 1, 2, 3, 4, 5 impulse, wave B is another corrective pattern, and wave C consists of another impulse, and so on. And the last and probably best option in this case would be, at least in my opinion, to simply sit back, wait until there are more new candles on the chart that make it clear which case to follow, and in the meantime simply pick another asset to invest or trade where all or most of the valid ways of applying Elliott Wave Theory currently point in the same direction. Besides all of that, one other very important thing to know and understand is, since corrective patterns also exist in variations that combine multiple corrective patterns, they are the hardest part to identify correctly, even with tools like the Kennedy channeling technique or the books or the one-page cheat sheet, and jumping to conclusions too fast about wave 2 and 4 can therefore lead to bad market entries or very long waiting times, like in our example here, where we opened our wave 5 trade actually while wave 4 was still ongoing. In other words, it's in my opinion best to look for charts that clearly show a third or fifth wave started and invest in those instead of trying to pinpoint the exact corrective pattern and the potential bottoms during second and fourth wave movements. That said, while Elliott Wave Theory is in my experience the most accurate tool at your disposal, it's in the end just another tool, and a quite flexible one at that also does not guarantee your success but should help you have more winning than losing trades in the future, especially since its rules always provide you with clear stop loss and reasonably clear take profit targets. And I get that this video contains a lot of information to process and, as mentioned, just scratches the surface of Elliott Wave Theory, but I do hope that you were able to understand the core principles and now fully understand Kennedy's channeling technique to faster identify impulse wave patterns. I would strongly recommend that you get yourself a copy of the book linked in the description below, or at least read the free online version that is also linked down below to deepen your understanding of Elliott Wave Theory, and then just use it maybe first on a demo account to try to determine where prices are going to turn around next. That's it. Thanks for watching this video. If you have any questions, feel free to leave them in the comments down below or on any of my recent posts on eToro. Thanks for watching, see you in one of my other videos. Till then, bye bye!